What if I told you that the company supplying the backbone of the entire AI revolution, a firm controlling over 1/3 of the global AI server market, is currently fighting federal criminal indictments for allegedly smuggling billions of dollars in technology to China? And what if I also told you that, despite all of that, their hardware is still being built on NVIDIA's most coveted architecture, and the stock is sitting at valuations we haven't seen in years? Welcome back to Smart Stock Sam, where we cut through the noise and give you the real picture. Today, we are doing a full reality check on Super Microcomputer, ticker SMCI. We are talking about a stock that once looked like the purest play on the AI boom, projecting a jaw-dropping 145% year-over-year revenue growth heading into 2026. But right now, it is caught in a violent volatility regime, drowning in audit uncertainty, a complete board restructuring, and a short float sitting at 18.5%. Here is what we are going to cover: the federal indictment that shook the market, the paradox between world-class hardware and catastrophic governance, what the institutional money is quietly doing behind the scenes, and, most importantly, whether this is a generational buying opportunity or a value trap waiting to swallow you whole. Stay with me, because this one goes deep. Let us start with what I am calling the SMCI paradox, and it is the single most important concept you need to understand before you put a single dollar near this stock. On one hand, Supermicro is a critical node in the NVIDIA ecosystem. These are not peripheral players. They are building the actual physical infrastructure that powers the AI arms race. On the other hand, the governance holding this company together is, frankly, collapsing from the inside. Here is the data point that should stop you cold. On a single trading session, SMCI dropped 33%, not 33% over a month, 33% in a single day. That kind of move does not just shake out weak hands. It fundamentally rewrites institutional risk models. It shifts sentiment across the entire AI infrastructure sector. Now, under normal circumstances, in any normal market cycle, a 33% drop in a dominant, irreplaceable technology company would have every serious investor salivating. Buy the dip would be the war cry across every financial platform. But here is what changes the entire equation. The moment the word criminal enters the conversation, the rules of engagement are completely rewritten. Institutional mandates, compliance departments, fiduciary obligations, they all slam the door. And that is exactly what happened here. So the question that should be burning in your mind right now is, can world-class technology survive catastrophic leadership? Let us look at the specific event that triggered this collapse. On March 19, 2026, a federal indictment was unsealed by the Department of Justice. Co-founder Yixian Wally Liao, along with two other individuals, was charged with conspiring to smuggle approximately $2.5 billion worth of advanced AI technology to China, in direct violation of export control laws. The response inside the company was immediate and severe. Key employees were placed on leave. An acting chief compliance officer was rushed in to perform a complete overhaul of SMCI's trade compliance framework. The board scrambled. But now, here is where this story gets genuinely strange. At the exact same moment this legal storm is ripping through the executive suite, SMCI's engineering teams are heads down, launching next-generation liquid-cooled server architectures built directly on NVIDIA's Blackwell and Vera Rubin platforms. The hardware pipeline is not just intact, it is cutting edge. The products being built right now are the kind of infrastructure that hyperscalers dream about. So ask yourself this: is it even remotely possible that a company under federal criminal indictment could simultaneously be delivering the most advanced AI server technology on the planet and win? Could the engineering excellence actually outlast the legal chaos? That tension is what makes SMCI one of the most electrically charged trades in the entire market right now. Let us talk about what all of this has done to the valuation, because the numbers here are genuinely striking. The aggressive sell-off has compressed the price-to-earnings ratio from its historical highs all the way down to a range of 9 to 15 times earnings. That is not a small compression. That is the market essentially saying, we do not trust these earnings to persist. The stock is currently trading around $21.58, dangerously close to the 52-week low of $19.48. We are looking at a roughly 50% decline over the trailing 12 months, effectively erasing every single gain made during the 2024 AI euphoria peak. Now, on a purely mechanical valuation basis, if you strip away every lawsuit, every headline, every compliance failure, this equity looks statistically cheap. 9 times earnings in a high-growth technology sector is the kind of number that gets value investors excited. But, and this is the critical but, cheap only means something if the company survives the Department of Justice. And that is not a given. So while retail traders are circling this like a value play, the institutional money is doing something very, very different. What the smart money is doing can be summed up in 2 words: getting out. In the most recent quarter, the number of institutional owners in SMCI dropped by 36%. We are not talking about trimming positions. We are talking about a full-scale, coordinated departure of professional capital. Major names, Vanguard, BlackRock, State Street, have slashed their average portfolio allocations to SMCI by 33%. Firms like Bank of New York Hampshire and EMC Capital made complete and total exits. 18.6 million shares were dumped by institutional players in a single quarter. Now here's the question you absolutely must sit with. What do these firms, with armies of analysts, legal teams, and risk departments, know that the average retail investor scrolling Reddit does not? Because when the most sophisticated capital allocators on Earth are running for the door, that signal deserves enormous respect. It does not mean the stock cannot bounce. It means the risk-adjusted case is deteriorating fast. And that brings us to the most revealing split in this entire story. Right now, there is a fundamental divergence in how different groups of investors are reading SMCI, and the gap is enormous. On the retail side, communities like RR Wall Street Bets are holding an occasionally bullish thesis, anchored on one key point: SMCI itself is not a named defendant in the DOJ indictment. The company, they argue, is not on trial. Specific individuals are. That distinction matters to them. On the professional side, the picture is darker. Bernstein just reiterated a market perform rating with a price target of $37, and they specifically cited a severe credibility overhang as the primary concern. CJS Securities is even more pessimistic, reaffirming market underperform due to serious concerns about the long-term financial trajectory. The professionals are not just worried about the legal drama, they are worried about the underlying math. And when you see what the numbers actually say, you will understand why. Let us talk about the math, because this is arguably scarier than the DOJ. Everyone in the financial media is leading with the headline number, 123% revenue growth. That is a number that stops you in your tracks. That is a number that makes you want to buy first and ask questions later. But here is what they are not leading with. Gross margins have collapsed from 11.8% just 1 year ago to 6.3% today. Nearly half the margin has been destroyed in 12 months. SMCI is, in effect, buying its revenue growth by sacrificing profitability. They are winning contracts by pricing aggressively, and it is showing up brutally at the bottom line. Here is the terrifying logical extension of that trend. Even if SMCI hits its $40 billion revenue guidance, which is a massive number, it will not translate into meaningful earnings if margins continue sliding toward 5%. They are running faster and faster on a treadmill that is quietly speeding up beneath them, and the charts are now reflecting exactly that fundamental deterioration. Looking at the technical picture, the verdict across virtually every time frame is a strong sell. SMCI is trading significantly below both of its major moving averages, the 200-day at $30.78 and the 50-day at $28.41. These levels are no longer targets. They are dynamic resistance ceilings. Every time the stock tries to recover, it runs into sellers camped at these levels. However, and this is important, look at the relative strength index. At 25.25, this stock is in deeply oversold territory. The MACD is confirming sustained bearish momentum, but when an RSI reads this low, a relief bounce is not just possible, it is statistically probable in the near term. The question is whether that bounce is a genuine recovery or simply a dead cat on its way back down. Do not get too excited about a short squeeze just yet, because the data specifically argues against it. Yes, the short float sits at 16.46%. That is elevated, but the short interest ratio is only 1.22 days to cover. Bears can exit their entire position in roughly 24 hours. There is no mechanical pressure forcing them out. There is no squeeze trigger building beneath the surface. And then there is the dark pool activity. Off-exchange volume is running aggressively high at 41.17%. That means a significant portion of the institutional selling is happening in the shadows, away from the lit exchanges. The big players are positioning for further downside, and they are not in any hurry to cover. So where does that leave the price? Headed toward one very specific number that the options market is already circling. Welcome to what traders are calling the $20 pin. The options gravity map for SMCI shows a massive, and I mean massive, concentration of open interest at the $20 put strike. This level is functioning simultaneously as a psychological floor and a technical magnet. The closer the stock drifts toward $20, the more that open interest acts like gravity, pulling price toward it. On the day of the major crash, put options at this strike generated gains exceeding 5,000%. 5,000%. Meanwhile, call option holders were completely wiped out. Millions in premium went to zero overnight. With implied volatility currently sitting at 71%, the options market is explicitly pricing in another major price explosion, in either direction. The fuse is lit. The question is which way it blows. So, if you are actively trading this, here is your concrete blueprint. The current entry zone sits between $21.50 and $21.75. Provided we see price stabilize near the pivot point of $21.99. Your primary support zone, where the heaviest put open interest is concentrated, runs from $19.51 to $20 flat. That is your structural floor. If that level breaks convincingly, the next meaningful support does not appear until $17.25. That is a painful drop from here. On the upside, you are facing resistance ceilings at $23.19, and then again at $25.69. Until SMCI can clear those levels on volume, every rally should be treated with deep skepticism. Plan your exits accordingly. Near term, the most probable scenario is price remaining pinned near $20 while the market waits for DOJ developments. Any clarity, even partial clarity, from the legal process could be a meaningful catalyst. If we see macro tailwinds develop, perhaps a de-escalation of global trade tensions or a favorable regulatory update, a short-term target of $25.50 is achievable within a 2-week window. But the real prize, the medium-term target that gets long-term investors genuinely interested, sits between $35.71 and $41.13. Getting there requires two things: total clarity on legal exposure and proven stabilization of trade compliance under the new leadership team. Both of those are uncertain. Neither of them is guaranteed. So here is the final verdict on SMCI, and I want you to hear this clearly. Supermicrocomputer is currently sitting inside a valuation trap. At 9 times earnings, the equity looks statistically undervalued by almost every traditional metric, but statistical cheapness is not the same as investable cheapness. The federal criminal indictment involving the co-founder makes this stock effectively off-limits for the vast majority of institutional mandates, and institutional money is what drives sustained price recovery. The operational excellence is real. The NVIDIA relationship is real. The AI infrastructure demand is real. But all of that is being completely overshadowed by recurring systemic governance failures. And here is the risk that keeps me up at night. What happens if enterprise customers like Dell or HPE, watching this legal circus play out, quietly begin shifting their procurement decisions? What if SMCI's greatest competitive advantage, its speed and customization, starts getting eroded by competitors who can offer the same hardware without the headline risk? Until management can prove the NVIDIA partnership is structurally secure and internal compliance is genuinely modernized, SMCI will almost certainly remain range-bound between $19 and $25, with structural downside risk lurking below that floor. SMCI is not just a tech company right now, it is a legal drama with a ticker symbol. Now, before we wrap, the disclaimer you need to hear. Everything discussed in this video is strictly for informational and educational purposes only. Nothing here constitutes financial advice, investment advice, or a recommendation to buy or sell any security. Investing in high volatility equities and options involves substantial risk, including the potential loss of your entire investment. Always conduct your own independent due diligence and consult a licensed financial professional before making any investment decision. That is the reality check on SMCI. If this gave you a clearer picture, smash that like button, drop your take in the comments, and subscribe to Smart Stock Sam for analysis that does not sugarcoat the truth. I will see you in the next one.